Hello and welcome to the investment product presentation. My name is Young. I will be your guide once more. In this presentation, I will cover the basics of the most common types of investment products, specifically stocks, bonds, mutual fund, and a little bit about real estate. So, shall we get started? Stocks are one of the most common investment products that people tend to invest in. When an individual buys stocks, that individual is buying a share of the ownership in the assets and earning of a business corporation. In other words, they are buying a piece of that company. There are two types of stock that individuals can purchase. One is a common stock, and the other is preferred stock. Common stock are the most common and basic form of ownership. Common stocks are what people usually mean when they talk about stocks. Preferred stocks is a bit unique in the sense that these stocks give the owner the option to receive cash dividends before the company distribute the dividend to the common stock owners. So, if stocks represent an ownership of a company, then bond differs from stock in a sense that it does not represent an ownership of a company, but a loan to a company, government entity, or individuals. Yes, individual could issue bonds if they choose. When an individual invests in a bond, he or she is lending the bond issuer his or her money. In return, the bond issuer agreed to pay that individual a fixed interest rate for the use of their money. For example, if you buy a bond issued by 3M at 7% interest rate, you've entered into an agreement with 3M to loan them money for a certain amount of time. In return, 3M will pay you 7% interest for allowing them to use your money. The interest rate paid in bonds are fixed and the bonds have maturity dates. Maturity dates refer to the time it takes for the bond issuer to repay in full the amount of money borrowed back to the bondholders. There are many types of bonds. Some of the most common types include corporate, municipal, and sovereign bonds. Corporate bonds are those issued by companies or corporations. Corporate bonds can either be secure or unsecure. A secure corporate bond is backed by collateral, such as building, equipment, raw materials, and so forth. An unsecured bond does not have any collateral backing it. Municipal bonds are those issued by local government, such as states, counties, cities, or school. Sovereign bonds are those issued by national government, such as U.S. government or other foreign governments. Sovereign bonds have different names depending on which country issued them. For example, bonds issued by U.S. government are called U.S. Treasury, while bonds issued by the British government are called gilts. Sovereign bonds are usually issued in the country of the issuer and in the issuer's currency. So, U.S. Treasury, for example, are issued in the United States and are in dollars. Mutual funds are a collection of investment products assembled into a portfolio called a fund. These portfolios contain a certain percentage of stocks, bonds, real estate, and other investment products. One of the major goals of a mutual fund is to achieve diversification, which spreads risk across a variety of products. When one purchases an individual stock or bond, one takes on the risk of losing money if that particular entity performs poorly. One way to decrease that risk is to purchase stocks or bonds from more than one company or entity. The challenge with this for an individual is the cost. Purchasing multiple stocks and bonds might be too expensive and beyond an individual's reach. The solution to this challenge is to pool the funds from many investors and purchase a collection of investment products, thus creating a mutual fund. Each individual investor would own a portion of that fund. The size of the portion that an individual owns depends on how much money that individual contributes to the fund. Similar to a company that's managed by a CEO, a mutual fund is managed by a fund manager. A mutual fund manager is entrusted with purchasing and maintaining the investment products within a fund. There are two types of mutual funds. There are open mutual funds and closed mutual funds. Open mutual funds are one that issue shares to investors daily. The entity in charge of the funds will redeem or purchase shares for an investor, and they pay net asset value on the day that is sold. In other words, open mutual funds are the one that is more active in terms of trading. Closed-end mutual funds are the opposite. They only issue shares once, don't redeem share until the entire fund is liquidated, and if investors want to sell their share before the fund is liquidated, they can sell to other investors, not to the entity in charge of the fund. This is similar to trading stocks, where the selling and buying of stocks is done between investor and not between the investor and the company issuing the stock. Real estate is another investment product option. When individuals invest in real estate, he or she is investing in a physical property such as a home, commercial building, and the like. One way to invest in real estate is by personally buying a number of homes, commercial buildings, and the like, and then renting the property for profit. This way proved to be a little challenging for most people due to the amount of money needed to purchase the properties. Buying homes and commercial buildings could be very expensive. A more attractive way to invest in real estate is through a real estate investment trust, or REIT. REIT are companies that buy and own real estate. Individual could buy a share of the REIT and thus own a portion of the property that owned by the REIT. That's it for investment product. Thank you for joining me for this presentation.